The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Chip stocks shine, a bright spot in an otherwise dim market. Say that fast 3 times. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's take a look at where we stand with about an hour to go. Dim is probably right when it comes to the S&P 500, just barely higher, about 0.1%. As Romaine said, the chip stocks really in the spotlight today. That's helping to lift the NASDAQ 100 by about 100%. I'm really excited about this, though. You can see the Russell 2000 is your big winner today. Those little guys up about 0.5%. Probably has to do with what we're seeing in the bond market. A very slight bid coming into the long end. We are back below 410 when it comes to your 10-year Treasury yield right now, Romaine.
Yeah, the little guys are trying to outperform on the day, but it is the big guys up for a 5th straight day, at least as measured by the Philadelphia Semiconductor Index. And that's not being led by NVIDIA, believe it or not. It's being led by Astera, Credo, Microchip, AMD, the second-tier names, if you will. The sector swept up by more evidence of more spending by more AI companies. ChatGPT owner OpenAI, you got those new contracts with Samsung and SK Hynix. That's on top of the release this week of OpenAI's video generation app, as well as a report that Intel is in talks to maybe add AMD as a customer. The spending goes on. And that's good because when you take a look at this rally, it's really one of the few things out there getting bid today, day 2 of the U.S. government shutdown. And that is casting just a bit of a pall out there. 750,000 employees furloughed, a cost $400 million per day in lost compensation. President Trump may make the pain worse, said to be working to identify thousands of those furloughs that he could make permanent. A pressure tactic or not, it comes at an awful time for a labor market already under strain. Let's take a look. The federal government, after all, already had a hiring freeze that had pushed its employee total down for 7 consecutive months. A 3-month moving average for non-farm payrolls, which includes non-government workers, that's dropped from 200K in January to just 29,000 in August. And while the shutdown prevents an official government update tomorrow for September, there is industry collected data out there from Challenger that shows private U.S. employers scaled back plans to add jobs last month by 71% from a year earlier, the week of September, for hiring intentions, Katie, since 2011.
Well, as you mentioned, of course, we're not going to get that official government release tomorrow morning at 30 a.m. with the government shutdown. And then you take a look at the betting markets, where the odds are as to how long the shutdown could last. We have poly market probabilities up here right now for a 10 to 29-day shutdown. And you can see that we've moved higher, now sitting at 55%. Of course, this is just a betting market, so who knows? But at least when you're taking a look at the odds here, it seems like most in this market think that this is going to turn into weeks. And then it's not just jobs data we're talking about, Romaine. It's a whole host of other economic data that potentially investors, economists, and policymakers will have to go without.
Absolutely. Melissa Brown joins us right now, kicking us off to the close, head of investment decision research over at SimCorp. And Melissa, I do want to start with this idea of the potential for a prolonged government shutdown and what it actually means for a market, and for that matter, a Fed that was very dependent on some of these data points over the next few weeks and months to really decide what direction rates need to go. Are we flying blind, or is there going to be enough data out there from the private sector side to keep us going?
Well, I think for the short term, it's probably fine. We don't, historically, government shutdowns have not led to, poor performance for markets. But I think the more it gets prolonged, the more uncertainty that kind of swirls around the data that the Fed needs. And I guess you could argue that even with inflation data being higher than expected and they still cut rates, maybe they don't need the data. They're just going to do what they're going to do. But I think that would be a relatively weak argument.
There's been a lot of talk, of course, historically, when you take a look at government shutdown, certainly in the post-gold standard era, you have not seen very extreme market moves, maybe a few knee-jerk reactions in the middle as the negotiations go on. But overall, over the stretch of these shutdowns, financial markets, equity markets, to be specific, generally are relatively flat. Is there any sense here that we would expect something different this time around?
Well, I feel like this whole market that we've had for, whatever it is, a year or so, has been driven almost completely by two things. One is the AI trade, and the other is the expectation for the Fed to cut rates. That's obviously more recent. I think there's no reason to think that those two aspects of market drivers wouldn't continue. So maybe the shutdown is just a little bit of noise in the background, as opposed to something that is a cause of major concern. Of course, if it is really prolonged and people are not getting paid and therefore not spending money, we could start to see some impact on the economy. And where I would be concerned is when it ends and the data finally gets released, it could be a big surprise.
Absolutely. It could induce some volatility when we finally do get that delayed release. I want to talk a little bit more about the AI trade, because in your view, of course, there's still room to run when it comes to that narrative propelling the market higher. What does that mean for leadership, though? Should we just look at what the performance of the sectors has been for the past year and extrapolate that that's going to be the lineup going forward?
As anyone in the financial business knows, past performance is no guarantee of future performance. But I think it's actually a little bit heartening to see that the AI trade broadening out a little bit and maybe beyond just NVIDIA, because I think that maybe allows it to run a little bit further. I don't know how long it can run, but it probably has more legs with more participants than if it's just a couple of names. Yeah,
so that broadening out within the AI theme. Wrap valuations into this conversation, though, because as you mentioned, the AI trade has been the dominant narrative in this market for well over a year now. At that time, you've seen, of course, valuations get stretched, pushed higher. How much higher realistically could we go, even as we broaden out?
Well, that's a really good question, because valuations are stretched. I think the kind of saving grace for that argument is that if rates come down, then maybe you can stretch valuations a little bit higher. But I think by many measures, valuations, in general, not just for these stocks, are as high as they've ever been. And so there's probably not that much more valuation room to grow. I think you're going to have to see it in earnings in order to keep this run alive.
Well, we get another batch of earnings starting in roughly about 2 weeks' time, of course, starting with the financials. But once we get into that space with regards to big tech, which has been the primary driver of what is now at least roughly a 3-year bull market, depending on how you measure, do you think that the bottom lines that we're going to hear out of those companies, and more importantly, the forecasts, will justify the valuation?
I think, the bottom lines are always important. I think things like margins are going to be particularly important because, we have seen higher inflation than the Fed wants, than many people want. And I think it's going to be really important to see what's the impact on margins. Are labor costs going up? Are other input costs going up? Of course, that's going to flow through to the bottom line, but it's going to be, I think, an important component of those earnings reports.
Melissa Brown, always great to talk to you, head of investment decision research at SimCorp, kicking us off to the close here on this Thursday afternoon. When we come back, we're going to take a closer look at the shutdown, what it means for the Fed, a conversation with the former head of the Boston Federal Reserve, Eric Rosengren. We're going to get his thoughts here on the economy on pause.
Plus, as D.C. grinds to a halt, Nobel Mobile founder and CEO and former Democratic presidential candidate Andrew Yang, he weighs in on jump-starting the economy and why New York's current mayoral race is no small campaign.
Another great conversation after that as well. We're going to talk to the CFO of Upwork. Of course, with that jobs report from the government delayed tomorrow, all eyes right now on what private industry is doing to collect and disseminate that data. That conversation coming up in just a bit, right here on The Close. This is Bloomberg.
Well, big moves in the automotive space today after Tesla, Stellantis, and Rivian all reported third-quarter delivery numbers. And in general, EV sales have gotten a lift in recent months, with buyers trying to get ahead of that $7,500 federal tax credit expiring earlier this week. Here now with the broader picture on what's next for demand is Erin Keating. She is executive analyst over at Cox Automotive. Erin, great to have you with us. Let's start with Tesla here. I think a lot of folks were surprised to see these deliveries coming in just a touch under 500,000 vehicles. The big story out there is, of course, that pull forward of demand. When you take a look through these Tesla results, how significant do you think that was?
I mean, I think we saw it across the entire EV landscape, especially in the U.S. ahead of those credits expiring. As you said, it's significant that it shows people are interested in the vehicles. I know that a lot of people are putting real pressure on the fact that this EV tax credit was really driving demand, and certainly dealers and manufacturers were leveraging that in their advertising and their compelling offers. But the demand had to also meet that. So the consumers are showing a bigger appetite for EVs. And I think it's a solid sign for moving forward, even if we do expect a slowdown after this.
Well, that's the question, right, Erin? Is this the peak, that slowdown that we could be approaching? Have we truly seen some of the best numbers we're going to see for a while?
I think maybe for a bit, but we have to remember that, Tesla drew down on inventory, as did a lot of the other manufacturers. So as we move through the fourth quarter, we're also not going to see as many EVs even available for sale, because in anticipation of a softening in demand, a lot of the manufacturers started to draw back on production. Some have even announced that they're going to stop production on a few of the models. And so we're going to have to hold that in tension with what we're seeing as far as demand versus what's even available on the lots. But we've also already heard that plenty of the automakers are thinking they're going to carry over some incentives of their own to continue to juice those sales through the end of the year. Tesla, of course, is no stranger to that. When they want to go ahead and get more demand pushing through their showrooms, they are solidly in the camp of reducing costs on their vehicles as well. So I think we'll hit a speed bump. I'm not thinking it's going to be as aggressive as some automakers out there are thinking, but for sure we'll see some demand drop off.
Erin, I am curious, going forward, when we talk about the adoption of electric vehicles, what is going to be the selling point, or at least the marketing point going forward? If it's not about the potential affordability aided by government subsidization, is it about the environmental aspect, which it seems like nobody cares about anymore? Is it about more reliability? What is the argument?
It's a great question, Romaine. And here's the deal. I just bought an EV. So I will tell you, it's the car. They're great cars. The platforms are great. It's a propulsion method. I would argue that maybe we need to get back to a time where we're talking just, purely about the performance of a vehicle, the technology of a vehicle. They can compete against internal combustion engines and hybrid vehicles as far as quality, as far as, looking great with the design. There's so much more competition in the market now outside of Tesla. Great looking cars in more familiar shapes and sizes. I just bought the Ioniq 9, so looking a lot more like a regular 3-row SUV. And so I think a lot of this is going to continue to help more consumers find them to be great cars and really not in competition with themselves, but rather in competition growing against internal combustion engine and hybrids. And I think that that's what they really need to work on as far as making sure that people know that that's really the performance aspect of the vehicles.
Well, I am curious, though. I mean, as somebody also whose family just bought a new car recently, and we ended up going with a hybrid over an EV, one thing I did notice was I think a lot of sort of the bells and whistles that sort of had made EVs unique, you're seeing that now in regular combustion engine cars and in hybrid cars to a certain extent. And I mean, that was a big factor in our decision, where we kind of felt like, why pay the premium price for an EV when we're kind of getting most of what we can already get out of one of those EVs in a regular hybrid or ICE vehicle.
No, you make an excellent point. And honestly, in the U.S. market specifically, everyone isn't so concerned with all of the bells and whistles. There's plenty of people in the movement that want to go back to buttons, and the haptics of being able to switch on things and not have to scroll through menus on screens and such. So the technology is now ubiquitous. I think the more and more that people get to actually drive EVs and to get comfortable with the range that's available on most EVs these days. And, let's just be honest, we just put a ton of new EVs onto the roads of America through this big pull ahead, which means more people will see EVs, which means that more people will become interested in them. So I think we might be, we're not going to go into a crazy EVs everywhere, but I do think we've hit a critical point here where we're getting the technology, the propulsion method more familiar with people, and people are just simply seeing more of the vehicles on the roads. and potentially getting more interested in them because of that. And they're going to have to just weigh that against, where's their wallet? Can they afford the premium over the hybrid? Certainly, it's something to consider. But I think the incentives are going to continue to come from the manufacturers. They're all working really hard to bring price parity there. So I'm not sure that will, really lead us down a path where we're waiting until 2028 for legitimate adoption. We're not going to hit the huge numbers that perhaps the government initially wanted from us. But I see no reason that EVs are going to stop being popular, stop being interesting new vehicles for people who are in the market for a new vehicle.
Erin, great stuff. Great insights as always out of you and your team over at Cox. Erin Keating is the executive analyst over at Cox Automotive as you take a look at some of those auto sales numbers, particularly those delivery figures out of Tesla. When we come back, we turn to, the petroleum space, and more importantly, we turn to the deal-making space. Berkshire going all in on an acquisition for Oxy's petrochemical unit. We're going to talk about what's next for the energy company as the CEO squares off major new deals after this sale. This is The Close on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with RH. William Blair downgrading to market perform as tariff trouble brews for the luxury furniture retailer. The analyst says RH's average reciprocal tariff rate now likely to surpass 20%. He also raises concern that the company is actually ramping up promotions and clearance. The shares, which dropped about 10% last week, up about 2% here on the day. Next up, Mondelez. Berenberg, not so sweet on the chocolate maker, downgrading to hold. No near-term upside to earnings expectations across its cocoa coverage. That's what the analyst says. The firm highlighting an uncertain recovery in the U.S. consumer market as well as a weakening in European demand. Those shares down 2%. And finally, Novo Nordisk. HSBC giving the shares a shot of confidence and upgrade to buy. The analyst says the Ozempic maker's competitive position in the next-gen portfolio is actually improved, and he now expects the stock to return to favor as the market gets past concerns on tariffs and pricing. The shares up about 1% on the day, and those are some of our top calls. Let's go into the energy sector right now and take a closer look at Occidental Petroleum. The shares sliding after the oil company agreed to sell its OxyChem petrochemical unit to Berkshire Hathaway. It's about $9.7 billion in cash. Analysts see the deal deleveraging the company, even with the sale being below the $10 billion price tag that some folks on Wall Street had expected. Robert Thummel joins us right now, senior portfolio manager over at Tortoise Capital. And Rob, I do want to start with the valuation here. I mean, are you comfortable with $9.7 billion, or were you expecting a little bit more?
Well, I think I was in the market, maybe a little over $10 billion. I do think when you look at this type of business that Berkshire acquired, it's a classic Berkshire business. It's an easy to understand business. It's an absolutely essential business. Its earnings have been very consistent. So usually the multiples ascribed to those type of businesses are a little higher, but obviously Warren Buffett and the Berkshire team have been buying a lot of businesses over the years. So it was probably a fair deal. And the good news is, as you highlighted, it's going to allow Oxy to lower its debt level a little bit more now and be much lower levered going forward.
There was some concern here, though. I mean, when there was a lot of speculation about the buildup that that Berkshire, I should say, had in Oxy. But the idea that this petrochemical unit was supposed to sort of be the diversifier for the company's other businesses. So without it, where does that leave it? Does it leave it in a stronger position, not just in terms of the balance sheet, but in terms of its competitive industry position?
Yeah, well, it makes it a much stronger balance sheet, as you highlight, Romaine. But what it does, though, it does turn Oxy into more of a pure play oil and gas producer, right? Because they historically, like you said, they had a little bit of a balancing effect with this chemicals business that, when oil and gas prices went down, maybe the profits of the chemicals business went up. So a little bit of a diversification there and natural hedge in their business now that will no longer be there. So the business will be much more commodity sensitive, tied to the rise and fall of oil and natural gas prices going forward.
It's interesting to see such a negative reaction in shares of Oxy right now, down about 7%. I mean, as Romaine mentioned, some had been expecting a price tag maybe closer to or above $10 billion. We didn't quite get there, but then you weigh that against the fact that this will help deleverage the company, as you say, Rob. I mean, when you weigh those two factors, it seems like the market is voting one way, but do you think it's correct that the price tag being a little bit lower is more disappointing than the fact that it is going to help reduce the debt load?
Yeah, Katie, I think what the market's doing is looking forward and identifying the fact that Oxy is going to be much more commodity price sensitive. And so then it's a function of what do you think the oil price is going to be going forward? And we've owned Oxy in the past. I think it's got a great management team, but we don't own it presently because we believe that the oil price in the U.S. is going to go down temporarily. Now, we think longer term prices will go higher, but here in the next 6 to 18 months, our view is oil prices are going down. So that's why, at least for us at Tortoise, we wouldn't own a company like Oxy right now, even though it's got a great platform of assets and has potential and will be a long-term producer of oil and natural gas and really provider of energy solutions for a long time.
Well, Rob, it's interesting to hear you say that. I mean, the stated reason for not owning Oxy, that sensitivity to energy prices and oil prices. How do you approach the space as a whole then? Do you look for those companies that still have that diversification where maybe they're not as sensitive?
Yeah, so Katie, the way we played it at Tortoise for probably 2 decades was really look for the companies that really don't have that commodity price sensitivity, but still benefit from the fact that energy demand is going to go up every single year, and it's gone up 40 out of the last 42 years. So where do you get that? You get it in energy infrastructure, right? A lot of people underappreciate the fact that we need a lot of infrastructure. We have the world's largest energy infrastructure network in the world, and so that you can benefit from that because you don't have to worry about the commodity price, but yet get the energy exposure. So an example of that is Western Midstream. Western Midstream, actually, its largest customer is Occidental, but Western Midstream is an energy infrastructure provider. So it's got steady, consistent cash flows and the 9% dividend yield. We would rather play the Western Midstream angle, the energy infrastructure, because we think there are better risk-adjusted returns there than there are in Oxy right now, with the more volatile potential cash flow stream tied to what we think will be declining oil prices.
All right, Rob, great to get some time with you. Appreciate your perspective. That is Robert Thummel. He is Senior Portfolio Manager over at Tortoise Capital. Interesting to see not too much of a reaction in Berkshire shares. Usually the acquirer goes down, but that price tag kind of low for Berkshire.
Yeah, and it's kind of interesting too. But you would kind of expect that from Berkshire, right? I mean, they are kind of like the ultimate value, if you will, for lack of a better phrase here. So they're not going to overpay for anything.
No.
We certainly saw that under Buffett, and now apparently we're going to see that under Greg Abel as well.
Yeah, we'll talk a little bit more about that later in the show. But coming up next, I'm pleased to say we have former Boston Fed President Eric Rosengren. He is standing by with his take on the ongoing government shutdown and how a prolonged pause could impact the Fed's easing path. That conversation coming up next. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld. 30 minutes to go until we get those closing bells. A pretty quiet day in markets overall.
Yeah, you have a government shutdown, you have a Jewish holiday, so there's a lot going on, or not going on, I should say. But there is still some concerns here about the impact of trade policies, particularly when it comes to the agricultural sector. There have been multiple news reports over the last few minutes from Politico as well as the Wall Street Journal that the Trump administration is actually exploring a bailout of at least $10 billion for U.S. farmers. This would ostensibly be to help support that drop-off that we've seen from China buying a lot of our goods, primarily soybean and corn. And we should point out this is kind of reminiscent of what we saw during the first Trump term, when he also instituted some trade policies that caused China to retrench and then basically had to create some subsidies to help our local farmers.
Right, some precedents for this, like you say, coming from the first Trump administration. But as you say, the Wall Street Journal reporting that looking to use tariff revenue to fund that potentially $10 billion aid package, maybe to help the soybean producers. We'll continue to follow that story. But as Romaine mentioned, that government shutdown extending into a third day as Wall Street and Washington watch for any signs of compromise coming from Congress. Questions swirling right now about how this could impact the Fed's easing plans as another all-important interest rate decision approaches later this month. Joining us now to discuss, I'm pleased to say, we have former president of the Federal Reserve Bank of Boston, Eric Rosengren. Great to have you with us. And that is the question, right? When we think about that next Fed meeting, I would love to hear your perspective as a former policymaker. How much did you rely on alternative sources of data, private reports, for example, versus the official government data that would come out about the labor market?
So there tends to be a focus on official government data, though we certainly use data from private sources as well. So, for example, the ADP report that came out yesterday, people would certainly look at it, but they'd put much more weight on the employment numbers coming out of the employment situation report, which comes out on Friday in normal circumstances. But when there's a government shutdown, you have to rely on whatever data you can get your hands on. So I think we're in a period where more reliance on private data is going to be necessary until the shutdown is over.
And you look at the different pieces of private data that we are getting. You mentioned the ADP report that showed that private companies shed 32,000 jobs in September. You had interesting reports coming from Challenger today. You also had a separate report from a company called Revelio Labs, which I admit I'm not too familiar with, showing that the economy actually added jobs in September. So it feels like they're all telling different stories. And in your experience, I mean, how good of a picture can you throw together, cobble together of how the economy is actually doing from these different private sources? How does that typically compare to the official government data?
So it's certainly not optimal, particularly given that the U.S. economy in the first half of the year weakened relative to the second half of last year. So we already have consumption that's grew in the first half of the year only by 1.6%. That was roughly half of what it was the second half of last year. We have government spending that's also being cut back. And it looks like the consumer is pretty weak. So a number of the conference board came out earlier this week. Consumer confidence was weak. So we already know that consumption probably won't be all that strong. And then we're going into a shutdown where certainly government workers are not going to be interested in spending very much money because they don't know when they're going to get paid. And on top of that, there's a threat that a number of the government workers are also going to be laid off. So there's a good reason to believe that consumption is going to continue to be weak. Certainly, if there are both a shutdown and layoffs, government spending in the second half of the year is also going to be weak. So you already know that there's going to be a relatively weak economy and that more than likely labor markets are going to be weaker than we want. The problem for the Fed is that we're also seeing that inflation is going up. So the PCE, which is what the Fed tends to focus on, particularly the core PCE, was up a little bit, is at 2.9%. If you look at both private and the Fed forecasts, the expectation is that we'll end the year over 3%. That is higher than the Fed would like. It would like a 2% inflation rate. So it's still a difficult meeting for the Fed because it probably has a weaker employment report if we actually were to get one. And it also is a situation where the inflation data we've had to date, on top of the fact that we know that the tariffs are beginning to flow through to final goods, is an environment in which it's missing both of its mandates and has to trade off those two challenges.
I am curious about what the discussion ends up being. I know we're still a long way from the next Fed meeting. We still have like 4 weeks or so before we get there. But if you go into that meeting with the shutdown, and when you were Boston Fed president, I think you went through at least 2 or 3 government shutdowns, certainly the 2 that we had in 2018. And that was a time where, if I remember correctly, the Fed was raising rates and trying to make a decision about whether to continue to raise rates. So how much does the impact of a shutdown or the speculation about a shutdown affect the policy decision making?
Well, you know that it weakens the economy. It means that GDP for that quarter is going to be weaker. And if you're at a turning point, like possibly we are now, it runs the risk that we make a mistake. So let's say that you do a 25 basis point cut because the labor market's weak, even though inflation's a little bit too high. If this employment report would have indicated that payroll employment was declining substantially and unemployment was going up rapidly, that might be an environment where you'd be seriously considering 50 basis points. I think given that inflation's high, it's pretty, and with the data only being the ADP report, it's pretty challenging for the Fed to make a big move without better knowledge. So there's greater uncertainty, but there's uncertainty on both elements of the dual mandate. I think that the Fed will be pretty tentative at this next meeting. If we're in an environment where there's still a shutdown.
I am curious about how much federal employment actually affects our economy. When we use this number of 750,000 folks being furloughed, and of course we're now learning based on news reports that some of those jobs could be actually permanently reduced. I know that's still less than a quarter, I think, of the total federal workforce, but there has to be some sort of tentacles that come out of that affects the broader economy. Is it material?
I think it is material. So certainly the federal workers are going to cut back on their consumption patterns, whether they don't know exactly who's going to be laid off, if anyone's going to be laid off. They don't know how long they're not going to be paid for. But it's not just the government workers, it's also all the government contractors and the private sector employees that now are not also going to be paid by the government. And some of those cutbacks presumably are for the public sector, but there are also maybe cutbacks in contracting to the private sector. So there's a reasonable chance that this is more extensive. And given that the economy already was weak, I think it does risk, depending on how it's handled, having a more severe outcome than would be desirable. So the risks of a recession definitely go up. When you have a shutdown, you have less information. And if the economy already was in a possible turning point, it could be a serious mistake to allow the shutdown to continue for a long period of time.
All right, Eric, really appreciate you taking time for us. That's Eric Rosengren, former Boston Fed president. As we continue to keep an eye on the government shutdown in Washington, day 2, of course, not a lot going on in Washington because of the Jewish holiday, but we are learning that members of Congress are expected to try to resume some modicum of negotiations on Friday. When we come back, we're going to refocus in on the equity markets and one of the biggest movers of the day, Fair Isaac. The stock soaring after the credit reporting company announced a new program that will give it, well, a bit more exclusivity with mortgage lenders. We explain in our Stock of the Hour up next. This is Bloomberg. A big shakeup today in the credit scoring market. Fair Isaac, FICO is the ticker. It's your biggest gainer in the S&P 500, announcing a new program backed by the government that gives mortgage lenders the option to calculate and distribute FICO scores directly to consumers. Norah Mulinda joins us right now. Norah, just kind of explain to me why this is such a boon or potential boon for FICO.
Well, this is a massive deal for FICO. I mean, if you look at the stock, it's really been pressured this year, particularly off of the competition from VantageScore, which they are a private competitor. They have not gone public yet, but the idea of them coming out and getting this major deal that they got with the FHFA, where they decided that Fannie Mae and Freddie Mac could now also consider VantageScore and FICO scores when it comes to lending methods here. They are really seeing shares lower. So this is a major win for them, for a company that's been struggling a lot this year. This will essentially allow them to interact almost directly with consumers so that a lot of these mortgage lenders do not have to go through TransUnion, Experian, Equifax to get the FICO score. It'll come from FICO directly.
Yeah, talk about that a little bit more, because of course it's not just Fair Isaac, FICO shares popping right now. It's TransUnion, Equifax really in the hurt locker today. So just give us more context there about what this means for them.
Absolutely. And it's important to point out that Experian, TransUnion, and Equifax actually are the backers of VantageScore, FICO's competitor. So, I mean, this is really a knock on the head for them. That's why you're seeing shares falling. I mean, if you look at shares of TransUnion plunging for their worst day since 2023, shares of Equifax seeing their worst day since the pandemic 2020. So it really just shows that maybe FICO doesn't need these guys, right? That's essentially what this is starting to illustrate as they kind of get this major win.
Well, I saw some of the numbers. I mean, they were saying that basically right now, if you go through TransUnion, Equifax, you're paying about $10 per score. And FICO is saying we're going to offer this for basically $5, like the $4.95. So in theory, I mean, you're cutting your price in half. I guess the question is, did we have any sense as to whether other companies will maybe be able to participate in this? Meaning, like, what's stopping these other companies from saying, okay, we're also going to do this and charge $5 for it?
Right, and that's the question. I mean, I think as I talk to a lot of my sources, especially in the real estate market and financial market, it's really such a small, minuscule number that we're talking about, $5. And if you think about the grand scheme of closing costs, all that you pay when you're trying to close on a house, this is nothing in comparison to that. So I think that's also why FICO has kind of had an advantage here, and a lot of analysts don't see as much worry here for the company because we're talking about pretty minuscule numbers here in the grand scheme.
Well, FICO shares currently at an all-time high, the highest level since 1988 when it went public. Norah, Mulinda, great reporting as always. A big shakeup. Romaine, what's your credit score?
My credit score is 63.
Wow, okay.
Is that good?
I think it could be better, but you have some room for improvement.
No, sorry, that's my Uber score.
Okay.
I don't know.
No,
I don't look at that crap.
That's not good either.
But I mean, it gets to this idea too. There's a broader discussion to be had about just the I guess, reliability of some of these scores, and we've spoken on this program with some lenders that said they've actually backed off on some of those standard scores coming out of FICO and the others. They're going for more of a composite model to determine someone's credit worthiness.
Yeah, I like to check mine every month, and it's always different depending on where I look.
Do you really?
In any case.
Every time you swipe your card or something, I think, doesn't it change, right?
Something like that,
So that protein latte that you paid, what did you pay for that, like $8?
Like $11.
$11?
Not quite. The close is up next. This is Bloomberg.
Just about 10 minutes until we get to the closing bells. Romaine Bostic alongside Katie Greifeld. Looks like we're setting up for another record day. Modest gains to be sure, but record highs again. Katie Greifeld, don't poo-poo it. I see the look on your face.
Well, as long as the color is green on the S&P 500, it's an all-time high. It's interesting to see the small caps breaking away here. You might think the bond market is helping out, but just a little bit. I mean, we're looking at a 1 basis point rally on the 10-year yield, but the little guys breaking free right now. Big tech also having a good day with those chip stocks.
Yeah, absolutely. And I've kind of been a little bit surprised at the resiliency that we continue to see in that trade. But I guess some good news, if you will, on OpenAI. Did you download the new video
No,
app,
I feel like that's a little dystopian for me.
Dystopian? Well, it's kind of where we're going, Katie Greifeld.
It's true.
So embrace it or get left behind. That at least seems to be the message coming out of the market these days because, of course, it is chip and big tech that continues to lead us higher, and higher. And the big question now is anyone hedging to the downside? Mandy joins us right now, VP and Head of Derivatives Market Intelligence at CBOE Global Markets. Great to see you, Mandy.
Great to be here.
I do want to talk about this idea of whether we are so skewed to the upside that we're kind of setting ourselves up, at least in the equity market, for some pain should anything go wrong.
Interestingly, we are seeing a little bit more caution in the derivatives market of late. I would say in terms of the flows that we're seeing in the S&P 500 options market, we're seeing more of a pronounced uptick, particularly for year-end hedges. If we're looking at different tenor options, where we've seen kind of the biggest demand for those downside puts have come at like the 3-month tenor. So really people taking the opportunity. We've had obviously a great run, as you guys have alluded to, in the equity market. People taking the opportunity to lock in gains, especially with the VIX and with vol levels where they are. I think this is an opportune time.
Are you seeing a tick up in volatility or volatility expectations, I should say?
Not so much. No. So I mean, overall volatility levels are very low, particularly in the near term. Now, one thing that has been consistent in recent months has been a very steep term structure, meaning that people are pricing a little bit more premium for options that are a little bit longer dated. But I would say that's more about 6 months to 1 year out. In the near term, I would say volatility levels remain rock bottom.
Is that true at the single stock level as well? When you compare what we're seeing at the index level, how people are hedging, what they anticipate when it comes to volatility, and stack that up against individual names, is it the same story?
It's actually a very different story, and I think that's part of the reason why index volatility is low is because there's been such incredible dispersion at the stock level. We have seen a lot of single stock volatility, and actually right now in particular, we're seeing actually single stock volatility rise quite significantly going into earnings season, right? So that usually is a pretty big catalyst for volatility at the single name level. And this time around, we're seeing the same thing happen, the same pattern. And you see it with the VIX EQ index, which is our VIX index for single name volatility. The spread between that versus the VIX near a year-to-date high.
Interesting. So it sounds like this is par for the course. This pattern usually plays out this way, that heading into earnings season, you do see single stocks diverge a bit from the index.
So the pattern is not surprising. The magnitude certainly, I think, stands out. The fact that we are at a year-to-date high, to me, is interesting. The fact that the spread is widening going into earnings season, I would say that is par for the course.
What does it tell us about risk sentiment when we continue to see stocks kind of inching, and I don't know if we call it melt up, but this idea of continuing to go towards these record highs? At the same time, where we see a safe haven like gold also setting consecutive record high after record high.
Yeah, I think that's been kind of the conundrum or the puzzle for a lot of investors, is that you're in a year where risk assets have done so well, but at the same time, the best performing asset is gold, which is traditionally a safe haven asset. I think really both performance can be explained just by the expectation of kind of Fed easing and the loosening of monetary conditions, financial conditions. But in terms of risk sentiment, I would say, what we're seeing in the volatility market is people focusing more on idiosyncratic risk, right? So, for example, earnings or themes such as AI, and less so on macro risks. And that's why levels of implied correlation in the market is so low. So right now, I say people are focused on idiosyncratic stock drivers, and they do not see any macro recession type of risk in the market. If you had to pick up the phone and call 100 of your clients and ask them whether they cared about the government shutdown, how many of them would say yes? Zero. I mean, maybe that's an understatement, but I would say I think this is a catalyst that does not get a lot of,
What about, is it any different when you take a look at bond market volatility versus equity market volatility? Because if you did want to get worried about the government shutdown, or you were looking for places where it might cause a ripple, maybe there's a higher likelihood in the fixed income market?
So bond market volatility is similarly at very depressed levels relative to equity. The only cross-asset vol that is screening rich and out metric is really gold, and that's coming from upside demand, as we talked about, right? People continuing to pile into gold. I think really what is going to drive the bond market and volatility really across asset classes is going to be the Fed. And I don't think, unless the government shutdown goes on for such a prolonged period of time that it really starts to impact Fed policy, I don't think it will be a major catalyst when it comes to market direction and levels of volatility. Not yet.
Not yet, not yet. That seems to be a persistent theme. I do want to talk a little bit about, if you were looking to hedge, what makes sense here. We were speaking with Julian Emanuel of Evercore earlier this week, and he made the point that buying puts on the Qs right now, maybe that looks okay. And I wonder, when you take stock of this market, particularly the options market, what makes sense in your view?
Yeah, so I think if you're looking to using options for hedging purposes, there are a lot of things that screen attractive, because implied volatility on an absolute level is near one-year lows across the board. That's the case with S&P. That's the case with QQQ, with a lot of indices, and we're actually seeing a very pronounced uptick in option activity in the S&P in particular. So September was actually a record volume month, which surprised a lot of people, I think, because you think April, with what happened post-Liberation Day, would be the record high for option activity, but September actually surpassed that record. I think it's a sign of, in a time of uncertainty, or if you're concerned about market performance going to year end, more and more people are turning into options for hedging or for upside, depending on your directional view.
And you're actually seeing the kind of the options market, or at least the availability of options broaden out. There was a story today about how SoFi is going to be offering retail traders basically zero cost options activity. But there was also interesting research done by the folks over at Bloomberg Intelligence, and this gets back to where we started when we started talking about hedging. This idea that inverse ETFs basically are just kind of, the stepchildren now. They're basically out on the sidewalk, and nobody. And so it gets to this idea that some of the mechanisms that are out there to allow people to more easily hedge, they're not taking advantage of.
Yeah, I think the democratization of options, and in particular for retail investors, has been a really notable theme in the market over the past couple of years, both in terms of direct trading, like connecting through brokerages, but also through the availability of option-based ETFs, the proliferation of those, defined outcome ETFs, option-based income ETFs. The AUMs and those have grown like 7-8 times over the past couple of years, and that's really made option strategies more accessible for the especially end retail investor.
All right, Mandy, always great to have you. Mandy Zhu, VP and Head of Derivatives Market Intelligence at CBOE Global Markets, as we count you down to the closing bells with the Dow, the S&P, and the NASDAQ sitting on record highs. A full breakdown of all of today's market action starts with our global simulcast, and it starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. Carol Massar and Tim Stenovic join us from the radio booth. Welcome to our audiences across all of our Bloomberg platforms.
Everybody.
Carol Massar, everyone, well, almost everyone, you know who you are. But it is green across the screen today. Once again, Carol, with most of the major indices at record highs.
Yeah, absolutely. Kind of interesting to see that. I've been looking at the semiconductor names. They are really atop the major indices in terms of outperformance. The stocks, folks, just up about 2% here as we are just a few minutes away from the closing bell.
Typically, I'd talk about how, tomorrow's payrolls print will be an important one to watch. We're likely not going to get that as a result of the government shutdown. Instead, we're talking about some data from Challenger Gray in Christmas today, Katie, that shows this kind of no hire, no fire environment happening in the job market out there right now.
Yeah, it's a conversation that we're having, this urgency that's been placed on alternative sources of data and how complete of a picture you can put together about this economy when you look at all those different sources. And it seems like, of course, the answer has been that the official government data is still the gold standard, but we're not going to get that.
Yeah, just real quickly, too, just to point out to our viewers, seeing some headlines crossing the wire right now on Boeing. The shares they're still in the green, but took a slight leg down here. Now learning that 777X is said to slip into 2027, which, of course, would drive an additional billions of dollars in charges here. We're going to keep an eye on that story. But no matter where Boeing goes right now, the markets are still going to finish the day in the green and finish strong as they would. The Dow Jones Industrial Average up roughly about 100 points or about 0.2%, but that's going to be good enough for a record high. The S&P 500 only up about 5 points or about 0.1%, but that's also going to be good enough for a record high. The NASDAQ Composite and NASDAQ 100 each up about 0.4% to a record high. And the Russell 2000 closing higher by about 16 points or 0.7%, just about 10 to 15 points or so away from its last record high.
All right, and then when you dip back into the S&P 500, you do see slightly more names gaining ground on this Thursday, Katie. 278 names in the S&P 500, higher today, 221 to the downside, 4 unchanged.
All right, let's take a look at the sector level as well and see what the story is there. Take a look at the circle. And once again, information technology, your tech names are the biggest points contributor there. But you also saw some signs of life when it comes to communication services, industrials, materials. Those are your 4 sectors that finished in the green. What didn't do too hot today, consumer discretionary, energy, also consumer staples, dragging us to the downside. But when you have information technology showing up in such a big way, you're going to see things generally be green.
All right, let's get to some of the individual gainers. And I got to say, it's not names that I necessarily talk about a lot. Fair Isaac. All right, just before you judge, listen up. Fair Isaac, the ticker FICO, FICO. That one up as much as 32% in today's session, finishing with a gain of just shy of 18%. This surging #1 gainer in the S&P 500 after saying it will now sell credit scores directly to mortgage resellers. So it's a move that sent shares of third-party credit bureaus, Equifax and TransUnion plunging. So some changes there in that dynamic and selling of credit scores. Here's another one we don't talk about a lot, guys, but it caught my attention. It has to do with Microsoft's deal with the neo-cloud company Nebius Group, NV. It's going to provide computing power to internal teams creating large language models and a consumer AI assistant, according to folks familiar. So the arrangement, which is worth about $19.4 billion, sparked a rally in Nebius shares. Again, ticker NBIS. We don't talk about it a lot. Up just about 9% in today's session. This deal apparently outlined in early September.
Yeah.
But the announcement, there wasn't a lot of the specifics on it. When it was announced, though, the shares in the U.S., the ADRs jumped about 50% on September 9th.
Yeah.
So,
Yeah, no, I'm into the story. I mean, good one, Carol.
Well, the ADRs are up 335%.
But it gets to this idea, sort of like, of the idea of what options these companies have. I mean, we had the CoreWeave CEO on last week, and there was this whole idea that they were kind of, to a certain extent, the only game in town. Obviously, we know there are other companies, including Nebius and a couple others, but not a whole lot to go around, particularly when you take into account just how much capacity a company like Microsoft or Meta or Alphabet needs.
Right. So they're searching, right? Hence these neo-cloud companies certainly stepping up. Hey, one more, too. I think I mentioned it yesterday, AST Space Mobile. This one has been on a tear, rallying in the last couple of days, up another 16% today after gaining 16%.
Did you guys interview the CEO earlier?
The president, actually.
The president, okay.
It's really kind of fascinating. This is, you think about satellites up in the air and you think about Elon Musk and you think about SpaceX, but there are other players, including Amazon and AST Space Mobile, and this is a company that has been kicking up satellites into the air, kind of low orbit, but it's also all about really reaching kind of the cellular space, and this one has just been on a tear.
Yeah, they're partnering with AT&T and Verizon, whereas SpaceX is Starlink has partnered with T-Mobile, and he was telling us that the signal can actually get through one wall.
One wall.
So like if you're in a building somewhere, it can get through one wall. So it's not going to get in like a cell phone can, but better than, if you have a Garmin or something and you're inside, it doesn't necessarily work. So sort of better technology.
This is another outperformer this year. It's up about 200% year to date. Right now, though, 20% of the float is short, but nonetheless interesting. If you missed that interview, by the way, flipping my hair, you can check it out at Bloomberg.com.
Well, let's talk about some decliners. I want to talk about the biggest decliner on a points basis in the S&P 500. That would be Tesla, down 5.1%. Interestingly enough, shares were up as much as 2.5% earlier in the session, then turned lower. The company did report a surprise record quarter of vehicle sales. This as U.S. consumers accelerated EV purchases before those federal tax credits expired. Still, though, analysts are concerned about what things look like moving forward. Garrett Nelson over at CFRA said, looking forward, we still think there are major questions regarding the earnings impact of legislative changes on the tradable emissions credit market and EV demand in an unsubsidized U.S. market. Shares down 5.1% today. The second worst performer on a percentage basis in the S&P 500, that goes to Occidental Petroleum. Shares fell more than 7% today after the company agreed to sell its OxyChem petrochemical unit to Berkshire Hathaway for about $9.7 billion in cash. Analysts did note that the sale is below the $10 billion that they had been expecting. Also, Vicky Holub, the company's CEO, came out and said that the focus is now on organic growth after using about $6.5 billion of the proceeds from this sale to reduce principal debt at the company. Once again, Oxy shares down 7.3%. And finally, Equifax, off of what Carol was saying, Equifax down 8.5%. It is the worst performer in the S&P 500 today. Shares of credit reporting companies, including Equifax, plunged after Fair Isaac announced this new program that gives mortgage lenders the option to calculate and distribute FICO scores directly to customers. It's a major shift in how FICO scores are delivered in the mortgage industry.
Let's take a quick look at yields. A mixed day here. You did see the longer end of the curve continue to see yields move lower for the third day this week. Meanwhile, on the shorter end, you did see a slight uptick in yields. But we should just point out one of the fallouts of the government shutdown is because of that lack of data, volume in the Treasury market is incredibly light. Of course, remember, volume typically spikes around some of those big government data releases. And of course, not getting the weekly jobless claims today, and of course, not getting the monthly jobless unemployment numbers tomorrow here. So just take some of the price action with a bit of a grain of salt.
Yeah, it's going to be an interesting day tomorrow, no doubt about it. Hey, let's take a look at some stories that have definitely caught our attention. If you're worried about Taylor Swift, there is still some uncertainty about the environment.
What?
Don't worry.
The environment.
Well, there are some questions about kind of what comes next, right? We do see some people who are struggling with jobs and so on and so forth. But when it comes to Taylor's world, she's definitely set. Was it last year that we marked her a billionaire? Mm-hmm. And now it turns out she's actually a $2 billion year. Can we say that two?
She's doubled?
Multi-billionaire.
Yeah, $2.1 billion, according to the Bloomberg Billionaires Index. It apparently has a lot to do with just the money she's made being Taylor Swift. They think that she's invested it pretty well, given that her father's an advisor at, is it Morgan Stanley? I didn't know. I thought he was a
I know.
I thought he was a Christmas tree farmer.
I
thought he was a Christmas tree farmer.
Wait, I'm confused. I thought she was like
She grew up on a Christmas tree farm, but I understand that, maybe it was more of a side hustle for the family because her father did have some financial advisor roots, but also she's, a grown woman and smart on her own, so that probably helped too.
Merrill Lynch, excuse me.
There
Merrill
you go,
Lynch,
thank you.
Correction.
But her new album comes out tomorrow, I'm psyched, so that's probably going to add another cool $1 billion or so.
Are you dressing up and going to this movie thing or something?
I don't think I'm that excited, but I am excited to listen to it on the path home.
The only interesting thing about Taylor Swift, at least that I would have, is actually where is she putting her money? And, you talk about this idea sort of where to invest. Carol Massar, don't interrupt me, Carol. Did you take a look at OpenAI's valuation? $500 billion, the latest funding round here. I don't know.
money,
Did Taylor Swift invest in that?
I would love to ask her. You know what
I feel
she
like
did?
she's in low-cost index
You know
funds.
what she did invest in?
No.
Yeah, that's very
No,
funny.
not a chance.
She's buying munis, tax-free munis. No, she did buy back, remember her catalog?
Yeah.
And that's a really, really big chunk of her wealth, so.
I've heard, yeah.
All right, are we done?
I think so.
All right. Adios. All right, that'll do it. Our cross-platform.
I like that one album with the maroon.
Yeah, Maroon. That I think that was Midnight's.
Was that it? Okay.
Yeah.
All right. Are we done?
Good talk.
Take a couple edibles.
All right, our
listen to that.
cross-platform radio, TV, YouTube, Bloomberg Originals. Folks, Katie and Romain continuing there, of course, on the close. We continue on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow. The album will be out tomorrow, by the way.
And our coverage continues here on Bloomberg Television. A look at the market melt-up, a look at the government shutdown, and a look about what to expect for the rest of the month here in October. Kristen Bitterly is head of Citi Global Wealth at Work. She joins us after the break, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic here on this Thursday afternoon, day 2 of the government shutdown, and a financial market, at least in the equity space, doesn't seem to care. Another record high for the major indices and average in the U.S., including the S&P, the Dow, and the NASDAQ. Chip stocks out in front, leading the charge, but not necessarily from NVIDIA. It was a lot of those second-tier names that started to get a pretty strong bid on the day. The Philadelphia Semiconductor Index at a record high. Quantum computing stocks also rallying on the day. And look at that, Bitcoin. Katie Greifeld getting its mojo back.
Yeah, some risk appetite when it comes to the cryptocurrencies. Let's take a look at some of the stocks that were moving at the individual level. I have the biggest gainer on a percent basis in the S&P 500. That was Fair Isaac, FICO. Of course, we know the story there. On the flip side, your biggest loser on the S&P 500 was, of course, Equifax, down 8.5%. I wanted to highlight Tesla as well, because we know they came out with those delivery numbers really surpassing expectations. Tesla shares were higher, but actually finished the day lower by about 5%. We know a lot of that was a pull forward of demand with those tax credits ending for EVs. But let's get back to our top story of the day, and that is traders flying blind as government data goes dark. With tomorrow's job figures delayed due to the shutdown, policymakers and investors are instead turning to alternative data. But different sources tell different stories. An ADP report this week showed that private companies shed 32,000 jobs in September, while a separate report from Revelio Labs showed that actually 60,000 jobs overall were added last month, Romain. So certainly a lot of tea leaves to try to sort through and figure out where exactly the American labor market is.
Well, Kristen Bitterly joins us right now to maybe read through those tea leaves, the head of Citi Global Wealth at Work. And Kristen, I'll just put you on the spot here.
Sure.
And when you look at the economic data, I mean, do you see evidence of a slowdown?
So when we look at the economic data, when it comes to GDP, not at all. We're actually seeing really resilient data. A lot of that is driven, interestingly enough, by the AI CapEx spend. So this is the first time that we've seen AI CapEx spend exceed consumer spending in terms of the GDP growth. So all of this is connected from a market standpoint and then obviously an economic data standpoint. When it comes to the labor market, I think what we see is a stalling, not necessarily a slowdown. So we're seeing some deteriorating conditions, some cracks, but the questions remain, is it due to immigration? Is it due to AI productivity and companies planning ahead? Or is it due to tariffs? And probably the answer is some combination of the three.
Does it matter? I mean, even if consumer spending is a little soft, particularly in light of the big CapEx spend we're seeing on the business side, does it matter as much? I mean, I feel like in past cycles we would have been freaking out about this, but then you get all these headlines about Microsoft and CoreWeave and NVIDIA, et cetera, and it's like, well, okay, I mean, that's why economies have sort of, different sectors. So,
yeah, and I think the other thing too is just when we look at the consumer and the health of the consumer, the overall data and at the index level, it's not telling the full story because you have this concentration when you look at the top 20% of consumers by income levels, they're driving 50% of consumer spending. And so you could have this reality where you do see something like the unemployment rate going higher, but also markets are going higher as well because companies are continuing to deliver record earnings.
I want to bring this conversation into how you put together a portfolio because I do find it really striking that you have the S&P 500 at these all-time highs, and we keep seeing incremental gains bringing us higher. And then at the same time, this headline crossed about an hour or so ago that you take a look at U.S. money market funds hitting another all-time high. Now we have $7.4 trillion in cash. So how do you square that circle? Of course, equities at all-time highs, and still people cannot get enough of money markets.
Yeah, if you look at the flows actually into ETFs in September, we had year to date, I think it was around 900 billion into ETFs. September was a month where every single asset class was gaining net flows. So you had that across equities, you had it in fixed income, you had it in commodities. And when you look at those flows coming into the broad-based market, last year was a record year at $1 trillion, and so we're already at $900 billion. So people want to put capital to work, and they want to put it across asset classes. I think from a positioning standpoint, how we're positioned, it's very diversified. So we have equity exposure with a bias towards U.S., with a large cap bias as well, and we have fixed income exposure, but we are a little nervous about some of the inflationary pressures, which is why we're actually below benchmark when it comes to our duration at about 5 years.
I'm so happy you brought up the ETF flows. I live in that world. You take a look at the three biggest flow getters year to date. You have VU, that's a Vanguard fund tracking the S&P 500, IVV, that's the iShares version. Then SGov is the third biggest flow getter so far this year. That tracks 0 to 3 month treasury bills. So that's the whole story of this year. I hear what you're saying, that you want to be a little bit below duration, but what is it going to take to get people out of cash? You might have thought that the official kickoff of the rate cutting cycle might do it, but so far that has not been the case.
That has not been the case, and I think it would actually take a much lower rate environment to actually see a material move there, or perhaps a pullback in the market. But you can make the counter argument there that since there is so much cash sitting on the sidelines, the $7.4 trillion that you quoted, that it creates a little bit of a floor to the market. So going into earnings season, everyone's saying that the market is priced for perfection, but every time we've seen an idiosyncratic event, people use it as a buying opportunity. So we do see some of those flows if there's an opportunity with a particular stock, but I think for a material difference, it needs to be a fundamentally different rate environment.
Do you remember earlier this year when all the talk was about selling America, buying anything
I know.
overseas? Was that real? And two, is there any interest in doing that, any material interest in doing that as a diversifier right now?
Yeah, going back to the ETF flows, we'll talk a little bit about some of the international ones. They saw significant flows as well, and particularly with an interest in China, in Europe, as some of those diversification exposures. I think the challenge, though, is when you look at the purest expression of two particular views. One, AI, it's in the US market, and two, kind of this quality free cash flow generation that is also in the US market. So it's hard to see that outsized performance without having significant exposure here.
Right, that's the ultimate bull case on America. The US tech sector, Europe can't really compete, at least on that front.
I will say, though, if you're someone denominated in euros, the dollar performance is something that creates a little bit of a friction in those portfolios.
All right, Kristen, that's a good place to leave it. Great to get some time with you. That is Kristen Bitterly. She is head of Citi Global Wealth at Work. Now, still to come this hour, an interview with Erica Gessert. She is the CFO of Upwork. She'll discuss the findings of their latest monthly hiring report. That conversation still ahead. This is The Close on Bloomberg. All right, it's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And up first, the race to succeed Disney CEO Bob Iger is on, with one person emerging as the frontrunner, Josh D'Amaro. He is head of the theme parks division.
Which is the guy in the center, right?
I think so.
Okay.
He currently holds the title of chairman of Disney Experiences and has recently really increased his public profile by attending movie premieres, speaking at investor conferences, and chatting with company employees. Imagine that.
Yeah, chatting with them. But this shouldn't be that much of a surprise. If you remember, there was another CEO after Iger left who also came from the parks business. That was supposed to be his strength. And we're talking about Bob Chapek, of course.
Yeah.
And of course, investors weren't happy.
Yeah,
with
notably.
everything that he did. But that's been the driver of their business.
Yeah, absolutely. The theme park, sort of underappreciated, but notably Josh is not named Bob. So who knows? Maybe this will go okay.
Okay, well, I don't know. Maybe that'll X him out here. But anyway, let's talk about a guy named Greg Abel. He's the CEO-elect over at Berkshire Hathaway, sealing his first deal. That was the deal to buy the petrochemicals business of Occidental Petroleum. $9.7 billion. Berkshire now the largest shareholder in Occidental. And we should point out 9.7. It disappointed a lot of investors who were expecting more. But when was the last time Berkshire overpaid for something?
I know,
Kraft Heinz, that was about it? Yeah.
Exciting to see them buy something at all there. Again, we had been looking for railroads. Turns out we were looking in the wrong place. But last but not least, New York City's Democratic mayoral nominee Zohran Mamdani vowing to end the city's gifted and talented public school program for children 5 years and younger, quickly drawing a rebuke from his rival, former Governor Andrew Cuomo, who called it, quote, destructive. The program has been criticized by some for exacerbating school segregation. Of course, we'll be talking about the mayoral race a little bit later on with Andrew Yang. Looking forward to that conversation. But let's talk about hedge funds right now, because Bridgewater's flagship macro fund climbed more than 26% in the first 9 months of this year, getting a boost from the market uncertainty caused by tariffs. Now, hedge funds overall have posted solid gains this year, aided by surging U.S. shares and volatility in bond and currency markets from President Trump's trade war. For more on this space, let's go now to Bloomberg's Kathy Burton on the byline of this story. So a good year so far for Bridgewater. What exactly is going right for the flagship fund?
Well, they don't generally tell us all the ins and outs of that, but if history is any guide, it's probably bonds that have helped them, and currencies.
Bonds and currencies there.
Well, but we're talking about probably what is going to be probably one of the biggest outperformers that we've seen in more than a decade. Is that unique to Bridgewater, or are we going to see similar returns out of some of its peers?
No, I think we're going to see some strong returns across the board. There was a macro fund run by D.E. Shaw that's also up quite a bit. And we haven't seen all the returns yet, but I'm guessing that they're all going to be pretty good.
And this comes at an interesting time for Bridgewater. We were having the conversation in the commercial break that Ray Dalio really has stepped away from Bridgewater this year. He stepped off the board. He's, of course, sold out of his Bridgewater stake. So this really is a reflection of the team that's currently there in place and the new CEO.
That's correct, yes. And they've done a lot of things that I think have helped. They cut the assets a lot, which I think was very helpful to running the firm and getting bigger gains. Also, just the market is a better condition right now as well.
Does Bridgewater still have that mystique, though, that we kind of saw get built up under Dalio? I know Norah's been there for a while, and Ben Milkman now is, was he co-CIO or something?
He's the deputy co-CIO.
Deputy co-CIO. I mean, do they still have that same mystique?
I think that they lost it a little bit when they went through a period, like all macro peers, they did not perform very well for more than a decade. I think from 2012, they've annualized at just 3%. And that's even with last year when they were up like at 10 or 11%. But this is the first year of really outperformance.
Yeah, absolutely. That 26% gain, that puts the hedge fund on track for the biggest gain since 2010. So we're talking about the flagship macro fund. What sense do we have about some of their other funds, how they're performing? I know that Greg Jensen in particular has embraced AI.
Yes, and their AI fund isn't up that much. It's only up 6.5%, which I thought was interesting given how well their macro fund has done. Earlier in the year, they had said that the AI fund and the macro fund were neck and neck, but apparently something happened that the AI fund did not pick up or bet wrongly on.
Just real quickly, though, too. I mean, I was just kind of taking a look at some of the returns that we listed for some of the other funds out there, particularly when it comes to a lot of the multi-strat firms. I mean, Citadel at the lower end of that list, 0.72 as well. Have you seen a material difference in returns based on strategy, or is this more based on their actual execution of strategy?
I think that in these markets, most everyone has done well, except for some of the big multi-strats, like Citadel has not done well, given what their historical returns have been. My guess is that that probably has to do with commodities, which have been a big driver of returns in recent years, and the markets have not been their friends this year. So.
Katie Burton helps lead our coverage for this. And Katie, just taking a look at the list year to date, obviously we talk about Bridgewater being at the top, but the two best firms right now are in the macro space. Third best is credit, and a lot of those multi-strats. You have a couple near the top like AQR, but most of the other multi-strats really trailing.
Yeah, I was going to bring up AQR because Justina Lee also out with a story today that AQR's multi-strategy has gained about 15.6% year to date, those quant trades staging a comeback. But I mean, as Kathy told us, we're in an up market. This is a market where you would be expected to make money here.
Yeah, this S&P's up 14-15%, right?
Come on.
Okay, all right, not to brag.
But they're all about diversification. I have this conversation all the time. Hedge funds, you compare them to the S&P 500.
Don't do that.
You're not supposed to, right? It's all about the diversification that they add.
It's diversification, and they're going after, obviously, a client that has a much different need than just, a schleps who are just piling into broad market ETFs, Katie. No offense. When we come back, we talk politics with Andrew Yang, the former presidential candidate, right here on Bloomberg. All right, we're just about 5 weeks away from the New York City mayoral election, the general election, and the twists and turns continue with Eric Adams, the current mayor, making the choice to drop out of the race. That leaves Zohran Mamdani remaining in the lead, trailed by Andrew Cuomo and Curtis Sliwa. Our next guest is no stranger to running for office. He's a former presidential candidate, former New York mayoral candidate, and now the founder and CEO of Nobel Mobile. Pleased to say Andrew Yang joins us here in Studio 2. Great to see you.
Oh, thanks for having me.
All right, let's start off first of all with local politics. There's been a lot of hand-wringing over the possibility that Mamdani does win the election here in New York. And, Wall Street, real estate folks, a lot of people who are used to the status quo are concerned about some of the policies that he's proposing with regards to rent freezes and other things that could affect their business. I am curious, just in your read and having been in this city for so long, does that actually matter as much? Because it's one thing to go out on the campaign trail and make these promises. But as we've seen with other progressive mayors like Bill de Blasio, like David Dinkins, and a few others in the past, once you get in there, things change a lot.
Well, most observers agree that it's going to be nearly impossible for a lot of Zohran's campaign promises to come to fruition because they require buy-in from legislators in Albany. I think that the relationship that Zohran has with business leaders and the police in particular will be crucially important if he does become mayor next year. And he is the front runner. The key variable in this race is whether Curtis Sliwa remains in the race into November, because right now Sliwa and Andrew Cuomo are dividing the anti-Zohran vote.
I am curious just about what you make of Mamdani's rise, and primarily in the context of your ascent, too. There was sort of this hunger, particularly back in 2020 and even prior to that, for candidates who weren't from the traditional establishment, whether it was Democrat, Republican, whatever. And he seems to kind of be in that vein, for better or for worse. And I am curious as to what you think is driving that.
I think a lot of it is use of social media in a really native and adept way. I mean, you could see Zohran's message really resounded throughout the electorate among young people in particular, grew the voting base by tens of thousands in the primary. One thing, though, I think people should understand is that you had maybe 11% of New Yorkers vote in that Democratic primary. You need to have been a registered Democrat months in advance. Zohran's win in that primary may or may not reflect actually like the majority of New Yorkers. And it's one reason why I've been for open primaries here in New York and around the country, because I think that would be a truer test of someone's popular appeal.
Well, you make a good point that the primary, it doesn't neatly map over to the actual election. And you mentioned that Zohran Mamdani's campaign in particular has used social media very well. It seems like they have a lot of organic grassroots buzz. I want to compare and contrast what you make of the Mamdani campaign compared to what former Governor Andrew Cuomo has done, what Eric Adams had done in his campaign before he dropped out.
No, I talked about your native use of it. I think a lot of it is generational. Zohran's in his early mid-30s. I think Andrew Cuomo might be in his mid-60s or so. And so it's the difference between taking out your smartphone and using an app, which is what Zohran is doing a lot of the time. With Andrew Cuomo, I'm pretty sure it's going to be a staffer. And that might not seem like a lot, but it's kind of a lot. And everyone can feel it, everyone can tell.
You never know. It could be, Andrew Cuomo firing off those tweets. Who knows, though? I do want to broaden out and talk a little bit about America's broader national political scene. You, of course, are no fan of the two-party system. You founded your own third party as well. And over the summer, Politico had reported that, you had been in touch with Elon Musk. He has similar ambitions as well. Have those conversations progressed at all since the summer?
What has progressed is America's disenchantment with the two major parties, and you see it now with the context of the shutdown. But our system's not working. The question is what's going to get it to work. It's either going to be some kind of miraculous restoration of one party or the other, or it's going to be a group of independent Americans who raise their hands and say, look, we get it, we need something new. I'm on the record as wanting to talk to just about anyone who wants to make that new political alternative happen. And we did have some interesting conversations over the summer.
How'd they end up?
Well, let's just say the desire among Americans is growing all the time, and I see that on many different dimensions.
Do you think it's viable, though, in this environment that we could have not just a third party, but a third party that could actually be a formidable challenger to the two-party Democrat-Republican system?
100%, and I'm on Bloomberg's era right now. I mean, we all know Mike Bloomberg should be the patron saint of this as someone who ran for office as a Democrat, Independent, and Republican quite successfully. But I'm a math guy. There are 500,000 local races around the country, and tens of thousands of those offices are technically nonpartisan. Forward already has dozens of mayors and city council members and local elected officials who say, look, I'm tired of apologizing for Team Blue or Team Red. I'm Team America, or I'm Team my constituents. You could easily see that get to hundreds, even thousands of locally elected officials right now, like not even some kind of crazy new infusion of resources. And to create a different dynamic in Washington, D.C., you would probably only need 3 or 4 U.S. senators and maybe 6 or 8 members of Congress, either or, in order to completely change the politics of this country.
Are you actively, though, working towards this right now, or is this just kind of something that you would like to see?
I mean, we didn't get to 59 elected officials and rising by accident. And, you know, we're going to have exciting announcements. I will say one of the top 40 mayors in the U.S. is going to announce they're joining forward in the coming days. So, of course, we're working on it.
And we should point out, of course, that Michael Bloomberg is the founder and majority owner of Bloomberg LP and this network. But when it comes to moving away from the two-party system to potentially a three-party system, maybe even more, for a lot of people, that's viewed as sort of a pipe dream. And when it comes to making it an actuality, do you think it could start at the national level in a presidential election, or do you think that it has to start more local and then build up from there?
I think either could work. And you can imagine an independent primary with Mark Cuban and Mike Bloomberg and some other folks running, and the majority of Americans would say, sign me up for that. And you could have people vote in that primary on their smartphones in real time, as opposed to this strange, anachronistic, archaic, non-representative primary system that takes us to, no offense to anyone, Iowa, New Hampshire, South Carolina, et cetera. I mean, it would be modern. Folks watching this right now are like, oh, I run my life that way. I run my investment portfolio that way. Why am I allowing these parties to run our politics like it's still, you know, the 19th or 20th century?
Are you thinking about yourself running for office again? Any office?
Well, Romaine, I get urged to do so every day by New Yorkers such as yourself. I want good things for the people of New York. I want good things for the people of America. And the question is how we're going to get there. And my argument is that it's not going to happen in this current setup. So we should just, you know, roll up our sleeves and try and build something that will get it done.
Is our political system, though, healthy enough? And I say that, and this is going to be a bit of a loaded question, but there's a lot of concerns about the direction that the current federal administration, Trump administration, has taken us, whether we get to a midterm next year or a presidential election in 2028, that is even going to be fair enough to even allow for the potential of a third-party candidate.
I agree with your questioning our institution's ability to function. It's one reason why, for example, I was championing Dean Phillips challenging Joe Biden back in January 24, being like, look, the Democratic Party should have an actual democratic process, which they did not, which ended up with, in my mind, you know, like the wrong candidate and a result that I wasn't very happy with.
Well, you were disappointed that they just basically selected Kamala Harris without an actual
process. My joke was that they should change their name from the Democratic Party to the Selector Party, because that's apparently their process. And a guy named Dean Phillips gave his political career trying to make that case. He was a sitting member of Congress in good standing, and they pilloried him for making the point that, look, running an 81-year-old unpopular incumbent's not the right course of action. Instead of listening to Dean, what did they do? They cast him out of politics altogether. And I was there with Dean in New Hampshire making that case. So I agree with you that the institutions have not lived up to their promise this past period of time. The question is, can we rejuvenate them to the point that they can.
Well, I think a lot of people share your frustration with how the Democratic primary went down in 2024. But you mentioned the current government shutdown. Of course, we're on day 2. And I'd like to talk a little bit more about that, because it's interesting to see this situation where it feels like the shutdown is being used as a negotiation tactic on both sides when it comes to specific policies that want to be pushed through. And I wonder what you make of this in the political long term, what this could mean for both parties, because it seems like a delicate line that is being towed right now.
I see this shutdown as, unfortunately, an emblem of the institutional disintegration that we've been witnessing this past several years. It's bad for the economy, it's bad for the American people, and the reason it's happening is that Chuck Schumer took a ton of heat when he extended government funding in March, because what the base of each party wants is a fighter who's going to stick it to the other side, regardless of what that means for government employees or the economy. So you have these perverse political incentives that are dragging both parties in directions that may not serve the American people. I think that's why this shutdown could drag on, because we're talking about politics instead of results or any degree of deal-making common sense.
So, Andrew, you're wearing a pin on your lapel. It says Nobel. You recently founded Nobel Mobile, and I'd love to talk about that a little bit, what you're trying to accomplish there. I know that you were partly inspired by Mark Cuban and what he's doing in the PBM space.
Yes, check it out. Americans are sad for a couple of reasons. Number one, we're not saving enough money, and number two, we're staring at our phones too much, what my friend Hassan Minhaj calls our rectangles of sadness. So Nobel Mobile will cut your wireless bills. By the way, why do Americans pay twice as much as Europeans or Australians?
Why?
Because Verizon and AT&T are now paying $18 billion in shareholder dividends and not investing in network capacity anymore. I was a Verizon customer for 25 years, paying them $140 a month. And then I looked up and said, wait, why am I doing that? So Nobel Mobile gets you closer to what you should be paying and will pay you more if you use your phone less. So it's the ad is me smacking phones out of people's hands.
Smacking phones out of people's hands.
But it's the first carrier that will pay you to use your phone less.
You're also throwing these no phone parties. Maybe I'm getting the name correctly. I mean, how does that dovetail with all this?
We had 800 people come out to a phone-free party in New York. The New Yorker, apparently they're writing an article about it for next week. Thousands of people around the country. And check it out. I'm old enough to remember going to a college party and not having a phone because it didn't exist yet. So what we'd do is we'd look at each other and maybe we'd say hello to someone. And, maybe you'd even get someone's info. So these offline parties have struck a chord, and we're going all around the country with them. Offlineparty.com. I'm a party promoter in more ways than one.
I like to have 3 screens in front of me at all times, so I don't know if that party's for me, but Andrew, unfortunately, we have to leave it there.
This is the only time of day she actually talks to me.
Right, otherwise we text each other. Andrew, so enjoyed this conversation. Come back soon. That is former presidential candidate and the CEO of Nobel Mobile, Andrew Yang. Meanwhile, let's take a look at how markets closed on this day, on this Thursday, the second day of the shutdown. Of course, FICO up top with that 18% rally. The news there that it's going to sell credit scores directly to mortgage resellers. That sent shares of Equifax down about 8.5%, as you can see. And then Tesla, this is an interesting one. It was higher, then it was lower. They came out with their deliveries really beating expectations. A lot of that was a pull forward, though. That's reflected in the share price. This is The Close on Bloomberg.
Well, tomorrow, Friday, we were expected to get that U.S. government report on the September jobs picture. But of course, we know that is not coming, with the government shutdown continuing into what is likely to be a third straight day. And in the absence of government data, that means more of a reliance on private industry data. Revelio Labs showing employment increased by about 60,000 in September. That's an improvement from a month earlier. We got those Challenger Gray and Christmas numbers earlier today on hiring. And Upwork also out with its latest hiring report that takes a look at what skills are on the rise, especially in the age of AI. Pleased to say that the Chief Financial Officer of Upwork joins us right now, Erica Gessert. Erica, great to have you here. I know you guys put out this report every month ahead of the official government numbers. In absence of that, of course, I think all eyes are really on what you guys have to say. I am curious, where exactly are you seeing the biggest strength in hiring right now?
Thanks for having me. It's a really interesting time, for us to be publishing our report. And, our jobs report actually draws on over 1 million job posts. That draws on the freelancer economy, which is about $1.5 trillion strong worldwide. But the places where we are seeing the biggest surge is really where human oversight of AI tools is on the rise. Businesses are adopting AI tools at a record rate, but what they're seeing is that they really need human tools to counterbalance those AI implementations. And so we're seeing uniquely human skills like translation and localization up 29%, things like quality assurance, oversight of coding up 9% in September.
With regards to the companies that you survey and the folks that you survey here, is there a sense that all of the, I guess for lack of a better word, this makes it a loaded question, the hype that we've seen around AI is actually paying off, that there is a return on that investment that they're making in these people, in this technology?
I think it's been a little bit elusive for companies to really see the bigger returns from AI, in the current era. What we're seeing is, this phenomenon of AI work slop kind of coming through, and companies realizing that when they implement AI on its own, it's often, incomplete or inaccurate or even just plain wrong. And so they really need human oversight in order to supplement it. What we're seeing is, the demand for really human proficiency in AI tools across skill sets on our platform. And so what that speaks to is that the future is really human plus AI collaboration rather than substitution.
I wonder how AI is impacting the actual application and hiring process. I mean, a pessimistic take that I keep hearing just personally is that, okay, you have AI writing the resumes and the cover letters, and then you have AI that's screening those things and making the first decision there in the hiring process. Erica, I wonder what you make of that.
Yeah, I think this just speaks to the point that, you need a human in the loop in order to utilize these tools properly. We've implemented AI tools on our own platform to enable the hiring process. And what we see is that it really does improve the speed to hire. But ultimately, the implementation and addition of human judgment is essential.
Interesting. A nice, less pessimistic take than what I keep hearing. But I also have this... just in personal conversations, you talk to someone who's looking for a job right now, and it just feels grim out there. And it feels like the economic data is starting to match that as well. Looking through, what you're seeing on your platform, it doesn't seem as dark as maybe some of those conversations, Erica. But overall, the mood music, compared to the last few months, the last few years, it does seem like it's notably shifted here.
There's no doubt that, things are bumpy out there, and we're not seeing a lot of movement in sort of the external data. But what we are seeing, like I said, on our platform is that, as humans are adopting AI and becoming more proficient, 58% of our businesses are saying that they are looking for freelancers who are AI proficient to supplement the work that they're doing within their businesses. And so there is demand out there, and the demand is really across many, many, many job categories in order to oversee and supplement AI work.
Erica, I know that you're not an economist or anything like that, but when we start to talk about the government shutdown, the potential for actual permanent layoffs of some of these furloughed jobs, and what that actually might mean, we've talked a lot on this show about the pullback in federal hiring, and for that matter, at local and state levels, and how a lot of those people are now looking for jobs in the private space at a time where they're, at least in certain markets, are just fewer of them to go around. And I'm curious if you're seeing any sort of funnel of folks who are maybe coming out of that government sector into the private space, particularly in the freelance space, and looking for work.
Yeah, look, it's impossible to speculate, with the current shutdown exactly what the implications are going to be. Of course, we don't know how long. We don't really know all the functions that are going to be impacted. But it's true that Upwork's platform is a tremendous place for independent talent to come in times like these and find sources of work. And so, we're a great source for that. And we are actually seeing, kind of a nice increase in some of our volumes as it relates to that.
All right, Erica, really appreciate you taking time for us. Erica Gessert is the Chief Financial Officer over at Upwork. Upwork has a new report out, as they put out ahead of every government monthly jobs report, their sort of look at the state of hiring in the economy. And of course, we should point out that report we're supposed to get at 8:30 a.m. tomorrow. At least as of right now, it's not going to happen.
Yeah, unless something amazing happens. But I think we can stop saying likely when it comes to that report being delayed. And
I'm going to wait till 8:29.
Just to be sure, super sure to make sure nothing happens. But I mean, it really does put, as we've been discussing all show, policymakers in a bind, economists in a bind. Seems like investors are happy to just skate past this. And folks say that, this government shutdown, it won't have a huge impact on the economy. But still, when we're talking about key data releases, we're going to get more of them.
Yeah, we should point out next week was already going to be a relatively slow week for economic data. But the week after that, you start to get some of the more critical reports on CPI, basically the inflation readings that are really going to be a big determinant of whether the Fed cuts rates at its next meeting at the end of October. So if this does drag on for another week and a half or so, I think that's when maybe you start to get a little bit more concerned about how much visibility do we really have into this economy.
Absolutely. It gets more and more urgent as we get closer to that Fed decision coming on October 29th.
On October 29th. Stick with us here on The Close. We're going to set you up for, well, what to watch over the next 24 hours. Is there going to be something to watch?
Yeah, there's probably something.
All right, stick with us. This is The Close on Bloomberg. All right, welcome back as we wrap up our coverage here on this Thursday afternoon. A relatively interesting day in financial markets. What will tomorrow bring? Well, we were supposed to get that monthly jobs report for September. That's not going to happen because the U.S. government shutdown looks like it's about to enter into its third day.
But good news, we're going to have plenty of Fed speak to chew on. Williams, Logan, and Jefferson. Lori Logan has been hitting the tape hard this week. This will be like the third time she's spoken. Yeah, we've heard from Philip Jefferson earlier this week as well. But I guess in the absence of the economic data, we have to rely a little bit more on what the Fed members say, or maybe we look for alternative sources of economic activity, like Taylor Swift. Yes, releasing The Life of a Showgirl, going live at midnight tonight. What is her life like? Probably amazing. I have to say, she recently got engaged. I'm excited for the wedding. Yeah, I heard. That seemed like it made the news. It did, and then some. I am excited for the album as well. We'll see if it's as long as the Tortured Poets department. I hope that she employed an editor this time. Yeah, that's what you're going to do. Does that come out at midnight? You just I'll listen to it on my run tomorrow. Okay, all right. That does it for us here on The Close, but stick around. Balance of Power is up next, right here on Bloomberg.